What if everything you learned in economics class is already obsolete? Not slightly outdated. Not a little behind the times. Actually, fundamentally broken for the world you're about to enter. And here's the kicker. If you graduated in 2006, there's a good chance your economics education prepared you for an economy that no longer exists. But if you're sitting in a high school economics class right now in 2026, you might be getting something radically different. Or you might still be using the same textbook from 20 years ago. Today, we're going to find out which generation actually got the better deal. And honestly, the answer might surprise you. We're doing a full comparison. Class of 2006 versus class of 2026. What were they taught? What got left out? What got added? And most importantly, which group is actually better prepared to build wealth, navigate the workforce, and survive the economic reality of modern life? This is not a simple answer, and I promise you by the end of this video, you're going to look at your own education in a completely different way. Let's start by painting an accurate picture of what a typical high school economics class looked like back in 2006. The curriculum was heavily focused on macroeconomic theory. Students were spending significant time learning about supply and demand curves, GDP measurement, fiscal policy, monetary policy, and the role of central banks. There was a strong emphasis on understanding how national economies behave as large systems. You learned about inflation, unemployment rates, and business cycles. You studied how governments use spending and taxation to influence economic output. The Federal Reserve and interest rate policy were major topics. Now, none of that is useless information. Understanding how economies function at a macro level has real value. But here's where the 2006 curriculum starts to show its limitations. The application to personal life was almost non-existent. Students were learning how to analyze aggregate demand without ever being taught how to read a pay stub. They understood the concept of opportunity cost in abstract terms, but were never shown how to apply it to an actual budget. Credit, debt management, investing, and retirement planning were barely touched. If they were mentioned at all, it was in passing, as supplementary material rather than core content. The 2006 student also operated in a world before smartphones became universal, before algorithmic trading dominated markets, and crucially, before the 2008 financial crisis completely shattered public confidence in traditional economic institutions. The curriculum reflected a certain optimism about stable institutions. Banks were trustworthy. The housing market always went up. Your employer would handle your retirement through a pension. The economy was just a machine that experts managed, and your job was to participate in it by getting a good job, saving some money, and trusting the system. That worldview got absolutely demolished starting in 2007 and 2008, and the aftermath of that crisis, combined with the explosion of digital finance, remote work, the gig economy, cryptocurrency, inflation surges, and the complete restructuring of employment, forced educators and curriculum designers to rethink what students actually need to know. The shift took time. It was messy and uneven across different states and school districts, but by 2026, the direction of change is unmistakable. So what does a high school economics class look like in 2026? The biggest shift is the prioritization of personal finance as a core competency, rather than an afterthought. Students are now learning how compound interest actually affects their lives. They're studying credit scores, how they're built, how they're damaged, and why they matter for everything from apartment rentals to job applications. Budgeting is being taught with real numbers. Emergency funds, debt-to-income ratios, the true cost of a car loan versus a lease, these are concrete, actionable skills. Investing has also entered the conversation in a real way. Students in 2026 are being introduced to index funds, the historical behavior of stock markets, and the basic logic of long-term wealth building. This is enormous. The power of starting to invest at 18 versus starting at 35 is almost incomprehensible when you run the math. And the fact that this generation is getting that information early gives them a structural advantage in wealth accumulation that the class of 2006 simply did not have baked into their education. The 2026 curriculum has also had to grapple with digital finance in ways that would have been science fiction to a 2006 student. Digital payment systems, The basics of cryptocurrency as an asset class, understanding how algorithmic platforms affect markets, fintech applications, and even introductory concepts around data privacy and its economic value are now appearing in forward-thinking curricula. Students are being taught that data is currency, that your attention has a dollar value, that the free apps you use are not free because you are the product. That level of financial literacy around the digital economy is genuinely new and genuinely important. Entrepreneurship and the gig economy are also now integrated into the economics conversation in ways that reflect 2026 reality. The idea of a single employer, linear career path is no longer treated as the default. Students are learning about independent contracting, self-employment taxes, building multiple income streams, and the economic realities of platform-based work. When you understand that a gig worker needs to set aside a significant portion of their income for taxes and that they receive no employer benefits, you're learning something that will directly affect millions of young people's financial well-being. Now, let's talk about what got removed or significantly reduced in the transition from 2006 to 2026. Detailed macroeconomic theory has been deprioritized in many curricula. Students are spending less time memorizing economic models and more time applying financial principles. Some critics argue this is a mistake, that understanding the broader economic system helps citizens make better voting decisions and resist manipulation. There's validity to that concern. A generation that understands only personal finance, but not how monetary policy affects inflation, could be easily misled by political actors who exploit economic ignorance at the systemic level. The 2026 curriculum also has to compete with an overwhelming volume of financial misinformation circulating on social media. This has actually prompted some schools to add media literacy and financial misinformation identification as part of the economics curriculum. Students are being taught how to evaluate economic claims, identify misleading statistics, and recognize the difference between correlation and causation. That's a skill the class of 2006 almost certainly never received in any structured way. Global economics has also been updated significantly. In 2006, globalization was largely presented as an unambiguous positive force. Trade was good, outsourcing was efficient, and the flattening of the world was inevitable and beneficial. By 2026, that picture is far more complicated. Supply chain vulnerabilities exposed by global disruptions, trade wars, reshoring movements, and the geopolitical dimensions of technology supply chains have all forced a more nuanced treatment of international economics. Students in 2026 are learning that global economic integration creates both opportunity and fragility, which is a far more accurate picture of how the world actually works. Now let's have an honest conversation about which class is better prepared for real life. And I want to be fair here because this is where people often get emotional and tribal about their own educational experience. The class of 2006 has one structural advantage that's easy to overlook. They were trained to think in systems. Understanding macroeconomics, even at a high school level, builds a mental framework for seeing how interconnected forces create outcomes. That kind of systems thinking is actually valuable in leadership, policy evaluation, business strategy, and civic participation. When a 2006 graduate understood that increasing money supply could create inflation, they had a conceptual tool that helps make sense of the world they experienced from 2020 to 2024, when inflation surged in ways that shocked people who had no economic framework at all. But here's the hard truth. Systems thinking without personal application leaves enormous gaps. The 2006 graduate walked into the workforce without knowing how to negotiate a salary, without understanding that putting even small amounts into a retirement account at 22 versus waiting until 35 makes a difference of potentially hundreds of thousands of dollars. Without understanding how credit card minimum payments are designed to trap you in debt. Without understanding that an adjustable rate mortgage behaves very differently from a fixed rate mortgage. These aren't edge cases. These are the financial decisions that determine whether someone builds wealth or stays perpetually behind. The 2026 graduate, if they attended a school with a genuinely updated curriculum, is better armed for the immediate financial battlefield of young adulthood. They know what a Roth IRA is and why it matters. They understand how their credit score affects the interest rate on a car loan. They have at least been introduced to the concept of investing early, and letting compounding do the heavy lifting. They understand the economics of gig work and independent contracting. These are not small advantages. These translate directly into better financial decisions during the years when those decisions have the most long-term impact. However, I want to be careful not to overstate the case for 2026, because the curriculum improvements are still wildly uneven. Some schools in 2026 are genuinely teaching a modern, practical, financially empowering economics curriculum. Others are still running off materials that would have felt dated in 2012. Access to updated curriculum continues to correlate strongly with school funding and district resources, which means the students who most need updated financial education are often the least likely to receive it. There's also a risk in the overcorrection toward pure personal finance. A student who knows how to manage a budget but doesn't understand why inflation is happening, or how government spending affects employment, or why trade policy matters, is financially literate but economically illiterate. And in a democracy where economic policy has enormous consequences, that gap produces citizens who are easily manipulated by oversimplified narratives about complex economic problems. The ideal economics education in 2026 would combine the systemic thinking that the best 2006 curricula offered with the practical, applied personal finance focus that defines the best 2026 curricula. That combination produces a graduate who can manage their own financial life while also understanding the broader forces that affect it. Someone who knows how to invest, but also understands how interest rate decisions affect the value of their investments. Someone who understands their budget, but also understands why their grocery bill is higher this year than last year, and what that means at a policy level. So which class is most likely to succeed in life based on their economics education alone? Taking everything together, the 2026 graduate with access to an updated, quality curriculum has a meaningful edge for building personal financial health over a lifetime. The earlier you learn the practical rules of personal finance, the longer those rules have to work in your favor. The math of compounding, the avoidance of high-interest debt, the understanding of tax-advantaged accounts. These advantages are time-sensitive. Every year you delay learning them is a year of potential growth you never recover. But success in life is obviously more than money. Civic participation, critical thinking, understanding the world you live in, these matter enormously. And here, the class of 2006's deeper grounding in macroeconomic theory provides tools that the purely personal finance-focused 2026 student may lack. The real winner is any student, in any year, who gets both, who understands the machine and how to operate within it personally. That student, in 2006 or 2026, is equipped for a lifetime of financial competence and economic citizenship. The question for every young person watching this right now is simple. Which pieces of your education are you missing? And how do you fill those gaps before the cost of not knowing becomes too high to pay? Because in economics, as in life, the most expensive education is often the one you get from your own mistakes.